Greetings, everybody. It's Chris Karam here, Chief Investment Officer with Finspire, welcoming you to our last video of the year, our Focus on the Markets edition, fourth quarter 2024. Yes, appropriately titled Electoral Dysfunction. No, we're not doing any commercials. No, we're not selling you any pills today. But we are going to walk through the combination of markets and politics because we don't get to do this very often. Now, we are going to be talking a combination of everything that's occurred in the markets in the fourth quarter or in the third quarter, and looking ahead to the end of the year and also into 2025 as we look at the post-election edition as we move forward. All right, we intermixed a few good political quotes because it is the political season, and I'm sure you all can't wait to have those commercials stop running on your household TV. Anyway, I thought this one was pretty good. Be the first to admit I'm not the best public speaker, but I can read a teleprompter like nobody's business. Pretty fitting for George W. Bush. He was pretty funny. Very self-deprecating guy, especially when it comes to his way and his style of talk. All right, let's get right to the capital market strategy board. Let's hit the economy first. Look, the economy is slowing but still positive growth, and that is having a great impact as we avoid recession. That's actually becoming more and more important, especially as we look at things like bond yields and the direction of the equity market moving forward. So if we look at the third quarter itself, it was an everything rally for the markets. It was a great time to be diversified. Everything worked out. Stocks, domestic, international, bonds, across the credit risk spectrum, and especially with government bonds in the third quarter, having a great total return. And diversifiers like gold, emerging markets, and other asset classes really played catch up after lagging in the first couple quarters of the year. So we call it the everything rally in the third quarter of this year. And then politics. Politics is playing a really important role this year. Obviously, we have a general election. It's more than just the presidential election. We're talking more about Congress. We'll get to a little bit later in this presentation where we start to intermix some statistics about how markets behaved in different types of political outcomes. So we're going to get into that during this presentation as well. All right. I mentioned it was an everything rally. The equity market hit 43 all-time highs so far year to date as of the end of the third quarter. A big block of those 43 new highs came in the third quarter as the S&P 500 kept racing higher. Now, how did that happen relative to other asset classes? And yes, the S&P 500 has been leading the pack just like it did last year in 2023. But relative to these other asset classes, we're starting to see some catch-up numbers come up. So emerging markets really came out of nowhere. China had a huge, massive injection of stimulus, financial stimulus, monetary stimulus into their economy. At the end of the third quarter, it pushed Chinese stocks higher 15 to 20% in really short order, and that lifted the emerging market index up to 17%. International stocks up 13%. Balanced portfolios up 13%. Why? Because fixed income, which was negative going into the third quarter, perked up, had a very strong gain in the fourth quarter or in the third quarter of the year, and even small caps really started to rally as they were close to zero, 1 or 2%. After the end of the second quarter, and really surged in the third quarter, and all playing catch up to the S&P 500, again, much like last year. So what happens after the election? Election day is upcoming. It's very close by. And we do always see markets shift a little bit before the election, leading up to the month of October. We tend to see some selling in October, which is kind of like what we've seen so far in October of 2024. But look, there are a lot of reasons to vote. We're going to reiterate this, a lot of reasons to vote. Movement of markets may not be one of them, but there's always some interesting adjustments that the market does make as they prepare for the election, and then going up after the election between election day and inauguration day. But there's nothing really conclusive about this, right? When you look at the performance of the S&P 500, for example, regardless of who's exiting control of the White House, who's incoming, which party is outgoing, which party is incoming. Not a lot that you can conclude from that transition period. So that post-election period, look, we've had a real negative reaction, which was at the heart of the financial crisis at the end of 2008 and the first quarter of 2009, all the way to both the recent past year, Trump and Biden, both positive numbers during that transition period right after Election Day, and both had very strong performances throughout their terms. Now, Some cases this is puzzling, right? I mentioned a bifurcated economy. The manufacturing sector is still showing weakness and contraction. The services sector, which now accounts for the majority of the economic output, is showing expansionary territory. The leading economic indicators have been weak and actually showing recessionary levels for going on almost 2 years plus, but we never hit that recession indicator. We never hit that actual recession, which is important. And the growth has been steady. So where is it coming from? The most recent quarters here in this this navy blue column here on the right, see second quarter GDP came in at 3%. Amongst that, almost 2% of that was 2 out of the 3% growth was attributable to personal spending. But private investment, this is something that has been really strong and perhaps underreported. Investment in equipment, think of the cost of AI chips, for example, that a company might purchase from NVIDIA. These are expensive chips. And so there's been a big movement in general or private domestic investment, which is, think of corporate capital expenditures, for example, have been really significant. That's been a big driver of the economy, which is, as I mentioned, not talked about very much. Another general positive here is unemployment. The labor market still remains pretty strong, even though there's a lot of data that shows some conflicting areas or maybe some less appealing areas, whether it is the jobs being whether it's foreign-born workers taking a big chunk of the jobs, or perhaps it's an area where wage growth is falling, which is actually good for inflation. Or perhaps double and triple job seekers, right? People who have more than one job is certainly on the rise and is the highest level it's been in a while. There's a lot of numbers within the numbers, but at the end of the day, the unemployment rate remains modestly low at 4.1%, which is actually ticked down in the month of September from 4.2%. And then wage growth. Wage growth is getting back into an area that is much more palatable from an inflation management perspective. And that's why you see some other optimism about the inflation story. All right, Kamala Harris says the economy is not a zero-sum game. We can create jobs and wealth for everyone. Okay, we'll talk more about that a little bit later. And so far, earnings, when you look at the growth of earnings relative to the price of the S&P 500, you're seeing consistent growth in earnings, although it's not quite at the pace that it was. Earnings growth, that is. Earnings are still above this jagged line. And what you can see through history is earnings per share, which is in the earnings which are in the blue mountain, and the movement of the S&P in this jagged line. You can see where stocks can get a little expensive, okay, when this S&P 500 line approaches the blue mountain chart. We eclipsed that during the tech bubble of 2000. We haven't eclipsed that earnings mountain recently. However, we get the question all the time, are stocks expensive? Yes, stocks are expensive. Can they get more expensive? Yes, they can. And that previous chart is just an indicator of how much more expensive they can become. That being said, yes, large cap equities, yes, they're expensive. Remember, if you looked at this chart before, the bar charts represent earnings per share growth estimates, and the diamonds represent the current valuation. In short, you want a high bar and a low diamond to identify the best valuation opportunity. And you can see, yes, large companies, when you look at growth and general large cap in nature, yeah, the diamonds are above the bars, which means they're expensive. And are there other less expensive options? Sure. And we saw those really perk up in the third quarter. Things like mid-cap value, small caps in general, mid-caps in general, right, still offer valuation opportunities even after a good third quarter run. All right, we got to get Joe Biden in the mix. I mean, last time we did this video, literally during the video, I got a news flash on one of my monitors here that said that Joe Biden was dropping out of the race. So who knows? But so we had to throw him in here. We're going to come back to Biden's policies here in a little bit and look at how they compare against Trump for future consideration for movement in the equity markets. I think the economy is doing well, but there are still too many people who are struggling to get by. And that's true. And that's really what inflation and higher interest rates can do to many, right? And has done to many. And that is when we start looking at the yield curve and the story of high interest rates and higher inflation that we've been on for the last couple of years. What's really fascinating about this is that right before right before, or at the end of the quarter, I should say, the 10-year yield was closer to about 3.8, 3.6 to 3.8. And what I did is I updated this as of October 23rd. And today's yield curve, which is in, or the yield curve as of October 23rd, is in this blue line here, right in the middle. Well, this 10-year yield of 4.2% is a significant increase in yields from the end of the quarter, from September 30th. So the Fed cut rates towards the second half of September, and as it turned out, the 10-year yield, that's where it actually close to bottomed in the most recent past here. And that is something that's important, because we do have research that shows us that over four different periods of time in recent past, or 4 different periods of time where the Federal Reserve has cut rates, but the 10-year yield bottomed right around the time it actually cut rates. And that may have happened here, and this could be a signal to the economy and to the markets that, hey, inflation is still here. Whenever you cut rates, with a strong labor market and a positive growing economy, you run the risk of increasing inflation, which can upset the apple cart, not only with things that we pay for, consumer goods, etc., but also with stock prices. Now, this is a chart that we haven't looked at in the past, but when we look for individual equities to buy, we're always looking at things. Do they have a certain amount of earnings? Is the earnings yield there relative to the 10-year Treasury? Because it's a stock versus bond competition. Do you invest in stocks? Do you invest in bonds? Well, they compete with each other. You can go with yield and the forecast of the repayment of that yield versus taking the risk in the equity market. Well, oftentimes when you look at an individual stock, you look at whether or not they have the earnings yield that can surpass the yield of a 10-year Treasury. And historically, that spread is about 1.9%. And today it is around 1%, which means that stocks are a little expensive, not just from a valuation perspective, but also relative to bonds at these current rates. So that's something we want to keep an eye on. That's why the equity market tends to sell off when interest rates move higher quickly. All right, politics. Let's jump into it. Look, when whoever wins the elections, whether it's whoever wins the White House, Congress, or in Congress, is going to have to deal with this massive budget deficit and the massive $34 trillion in debt. This is how government can be dysfunctional. Donald Trump said we're going to have to raise the debt ceiling. We're going to have to go into debt to pay off the debt. Sounds wacky, but it's true. And that's in order to keep the government functioning. And so that's why when you look at debt payment, interest on debt payment as part of the budget, this is where it gets pretty scary, because you can see the forecasted areas here are in these dotted dashed lines. The projected interest payments are scheduled to skyrocket. And that just consumes more and more of our budget and really puts a lot of pressure on politicians to either cut spending or revise entitlement program or raise taxes. And none of those is a popular option, but they're going to be faced with the challenge of trying to grow out of this. If they don't want to do any of those things, then they're going to have to grow out of it, which is going to be a real challenge with anybody who takes the reins come November and come January of next year. Now, here is the real big challenge, because another thing to compound another challenge of not just the national debt and these large deficits, but the tax rates expire. The tax rates are scheduled to sunset that were put in place in 2018 are scheduled to sunset at the end of 2025. What does that mean? That means the race for Congress is really important, because Congress is really where, and the House in particular, House Ways and Means Committee is really where all tax policy emanates. Now, what are they looking at? They're looking at things like individual tax rates individual taxes on individuals accounts for almost half of the tax revenue. Corporate tax rates, interestingly, only account for about 10% of the overall U.S. tax revenue. Why is that interesting? It's interesting because the only tax rate that was made permanent in 2018 was the corporate tax rate at 21%. But as you can see, that was one of the smaller slivers of the bands here of where the actual tax revenue comes from. Social insurance. Hey, Social Security, there was a proposal. Trump put out a proposal there that says we're not going to tax Social Security, you're not going to tax tips, and a few other areas. That's a big chunk of where tax revenue comes from in the U.S. Treasury. So we'll see this is all up for grabs, all except really the corporate tax rates are primarily up for grabs and are set to change at the end of 2025, and that's going to be Congress's really big job. I mentioned earlier there's a lot of reasons to vote in the election, but the direction of the stock market's probably not one of the reasons why you want to vote. And you can see here, regardless of there's been a blue administration, blue Democrat or red Republican administration, with a couple exceptions. We've had general positive movements in the equity markets, and when you just look at Trump and Biden, it's been up in during both cycles by a significant amount. Now, what the markets really do like is gridlock. They like it when everything comes to a stalemate in Washington, D.C. And you can see, regardless of who's president, whether it's a Democrat or Republican, the best outcome in Congress is a divided Congress from a financials and capital markets and equity markets perspective. And that's not surprising. Why? Because they know the rules aren't going to change very much. And when you're an investor and you know the rules aren't going to change much, that gives you a lot of certainty looking out forward. All right, so let's take a look at a little bit deeper of how policies, and I know that Joe Biden's not running, but we have, of course, Kamala Harris, Vice President Harris, who is running and was also part of course, part of the Biden-Harris administration. So we're going to just do a compare and contrast here of what asset classes did better under Trump and which asset classes did better under Biden. The real fascinating part about this election is that we have essentially two executives who have track records, and they're actually we can compare them, and that gives us a pretty decent outlook of what we can expect moving forward. A couple things that really caught my attention. You look at things, the S&P 500 did well under both. As I mentioned a moment ago, growth investing did well under both. But you start looking at things like commodities. Commodities did really well under Biden. Now, we had a lot more inflation, and that's what lifted commodity prices. But you can see during Trump's administration, commodities really struggled as an investment. You also look at things like small caps, small companies. If you get a pretty big disparity in, say, Trump's term versus Biden's term, and that's also indicative of not just inflation rates, which may impact smaller companies more dramatically than large caps, but also the regulatory environment. There are very different regulatory regimes, and that favors certain companies, certain types of companies, certain asset classes under Biden as it did Trump. So we see some areas here where you could have different experiences, maybe not at the broad index level, but in some of these other diversifying asset classes can go a long way. So election upcoming, but hey, it's the holiday season. We wanted to thank you. We're very thankful for you, not only our clients, but also all of our contacts and friends in the industry. This is actually a recent opportunity we had to volunteer at the Ronald McDonald House in downtown Chicago. Here's our team. We actually cooked up a wonderful lunch. It was chicken harissa with rice and vegetables, and a dinner which included both a vegetarian and meat-filled shepherd's pie. And it was a lot of fun. We cooked for about 80 or 90 people, lunch and dinner. Great time to get away, do some volunteer work, and that's us here just a couple weeks ago doing our thing. So anyway, I'll sign off for now. As I mentioned, this might be the last one of the year, but unless something very significant happens post-election. But we're all looking forward to seeing you this quarter and having those great conversations as we close out 2024 and look ahead to 2025. Bye for now. We'll talk to you soon.